When I think about sustainability of a business, family businesses really are focused on sustainability. We're looking for the next generation. The prior generation was looking out about not just what are we doing today to be sustainable, but how are we going to have this sustainable for our next generation. That's something that we focus on a lot. We have a program for our next generation, which is the fourth generation, an internship program, so we're trying to get them acquainted with the business and familiar with what this entity is. And then the decisions we're making, we're thinking about how is this going to work for our kids and how is this going to work for our grandkids. And it really helps kind of bring the sustainability piece home for us. What do? We farm, we convert the crops to food products, we market and sell those food products, we own land and buildings, and we own equipment. Each one of those different processes suggests a different kind of a corporate entity. Just for those of you who are not familiar with our products, we have a lot of different products, from packaged rice to highly processed products like rice chips, which I know nobody here likes, but a couple of people like them out there in the market. And we really appreciate you continuing to buy them. I want to talk about 5 different organization types that we have. We have some other ones besides this that I don't want to get into, but first one is a C corporation, and that's Lundberg Family Farms. That's kind of what is the economic engine for all the rest of them. C corporation is a perpetual corporation. It's, if you see companies that are traded on the New York Stock Exchange, those would be C corporations. Ours happens to be privately held. So all the shares are owned by family members. I think we have 27 or 28 shareholders at the moment. We have, it's hard to read over there, but Weha Lundberg is an S Corp, and that's an entity that owns equipment that we use in our farming operations. And then we've got Lundberg Properties, which is an LLC, and that owns our land and buildings, and there's different purposes for that we'll get into in a second. We have Pacific Farms, which does a lot of our family farming ventures, and then landowners, which are in a whole lot of different configurations. If you can imagine, 28 family members owning land, some together, some with brothers and sisters, some with parents, some with cousins. There's a lot of different potentials. So why do we have multiple entity types? Well, first is the business purpose. What are we trying to accomplish with each particular business? Liability considerations. In our partnerships, there is no limit of liability. If the business loses a lot of money, the owners are on the hook for that. Whereas in a C corporation, you're only liable for the investment that you have in that and any retained earnings in that company. So if things go badly, you don't have to shell out extra money from in your own pocket. Just whatever you have in there, that's the limit of your liability. Another issue is different interests in investing. So for example, when a new piece of property comes up, not necessarily all 28 folks who are involved with the family all want to participate in that. People are different points in their life. Some people are trying to retire. Some people are trying to build. Some people are, happy with where they're at. So that's another issue why we have multiple entity types. Tax considerations certainly plays a large part of that, and it's becoming an even bigger part of it. We're trying to figure out, how do we not get taxed twice? In a C corporation, every dollar that you earn, you pay income tax, both federal and state. So about 40% of our earnings, if we make $1, 40% of that is paid in taxes before we make any distributions to owners. Yes?
That's a C Corp? Or?
That's in a C Corp.
Okay.
So there's double taxation there. So if we make $1, we pay the 40 cents at the corporate entity, and then if we were to distribute out the rest of that to the owners, then they would also pay their 20 to 40% taxes on that. So you may wind up with 20 cents on the dollar if you're looking at a way to distribute funds out of a C Corp. It's not the most efficient way to get money out to shareholders. Estate planning. With a family business, we're multi-generation. We're trying to figure out how do we get this entity to the next generation, and so that's another factor that goes into having another kind of entity. And then participation in government programs. We're a rice company. There are rice payments the federal government has, and certain kinds of entities are not eligible for those payments, or they may limit the amounts that you can receive under those programs. So that's another consideration in farming, depending on the type of crop that you have. Capital sources. Where do we get the capital to run all of this and buy land and build buildings? Well, for starting up entities, usually this is out of personal savings and debt. So some combination of the two. We're a pretty risk-averse family, so we have pretty low leverage ratios. But we do take on debt, and that can be a good thing for you. Just don't take on too much. And then on an ongoing basis, in addition to plowing your own savings back in, you can have retained earnings. And so if you made money and you didn't distribute it, that can be a source of capital for you on an ongoing basis. Governance. I thought I'd just talk about the C Corp because we've talked a little bit about the S Corp. We have our shareholders, and the shareholders elect the board of directors. They have to approve any dissolution of the business or sale of major assets of the business, or changing bylaws. Those are basically their rights as shareholders for governance. And then the board of directors that's elected by the shareholders, their primary job is overseeing the CEO. Different entities, different companies will have different roles for their board of directors, but typically managing the CEO is the #1 job of a board of directors. We also establish a framework and policies for the management with it to operate. We can't make all the decisions at the board level. We need to give some sorts of parameters for the people that are making decisions on a day-to-day basis. If you can imagine running a business with 180 people and every decision would have, are we going to buy these paper clips? Or are we going to buy this ream of paper? You don't want all of that stuff coming back to the board. But you do want to set up some policies, guidelines for people to operate within. And then protecting the assets of the company. That's a big job of the board of directors. And then management, they're charged with implementing all of this and operating the business on a day-to-day basis. Profits and losses. This is really about taxable income recognition. And this can be a little bit of a difficult concept for you if you haven't seen the difference between income that's stated on a tax return versus cash that you're getting in your hand. They're two very different things. So in a C corporation, the income, the profit and loss, is retained at that level. Nothing is passed on to the shareholders. Any cash that goes out through dividends, and those dividends are taxed. But in a C corporation, all of the earnings are retained and taxed at the company level. All these other entities, S corporation, LLC, partnership, sole proprietorship, all of those, the income is taxed at the individual level. So there's no entity tax other than the basic, somebody explained it to me once as the right of doing business, in California. So if you want to have the liability protection, there's an annual fee you have to pay for that liability protection, I guess is a way to look at it. Cash distribution is different than income. And so, I don't know how readable that is in the back there, but the way that you get your money out, that's what a lot of people who are starting in business want to know. How do I get my money out of this thing, assuming I have a successful business? In a C corporation, it's through dividends. That's the way you get your money back out. Through wages, if you're employed in the business, you can pay yourself wages and deduct those in the business. And then benefits, so your health insurance, your 401k, and other things like that. It's another way to get cash back out of the business. For an S corp, you get it through distributions and wages. You can't deduct benefits in an S corp. Is that? I think if you, there's some minimum percentage that you can if you own a very, very small percentage, but anyway, it's not deductible. LLCs, you get it through distributions. You can't take wages if you are an LLC member. It all comes through distributions. And then partnerships you can get through distributions and benefits. So that's how you get your money back out.
Sorry, I apologize for the very junior level question, but what do you mean by distribution?
It's not a junior level question. It's a great question. Distribution is the company says we have enough money available, we're going to write a check to the owners. And so it's called a distribution. That is, in and of itself, is not taxable. What's taxable is however much money you made. So it's possible that you could make $100,000 in your business and only distribute 20,000 in cash. You're taxed on the 100,000. You have the 20,000 to try to cover those taxes or whatever on it. If it's a distribution, it doesn't count as a wage. If you pay it as a wage, if you're an employee of the company, then you have to pay Social Security and Medicare tax and all the other taxes on that. Yes.
Kind of related to that. If you're starting a company and you're looking at this chart, how does the distribution get treated differently than a wage? Is it a tax issue? Is that why they're considered different things? Because it seems like they're both money in your pocket at the end of the day. So what's the difference?
Distribution is not taxable, but the income that enabled you to make that distribution is taxable.
In all the structures.
C corporation, it's taxed at the corporate at the entity level. All the others, it's passed through to the owners. It's a pretty complex concept to wrap your mind around. I know we have shareholders and we say, oh, you know, we made X amount of money this year, and you know, here's your check for a quarter of that. How did that happen? Yes.
Just throw in a little thing too, that if you look at the difference between what happens with the S corp or the LLC, with the S corp where you can pay yourself wages, S corp deducts some payroll tax on those wages. On the LLC, when you take that money home, then you have to pay all that tax yourself. So from that perspective, the S corp can end up being cheaper for you on the other side. It costs the company more, it costs you less when you take it home.
So I've got a bunch of slides, but I think I'm running out of time. On some reasons why you might choose these different types of, whoops, going the wrong way here. These different types of entities. So why might you choose to be taxed at a corporate level and have double taxation? Well, there are some reasons that you might choose to do that, besides being insane. For us, it's our primary economic engine. This is what generates all of the revenue for everything else. The liability is limited to the investment, so you know, if we were to have some catastrophe and we might get wiped out as a business, but whatever assets we have as individuals would not get touched. We can build retained earnings in this, so since those income is taxed at the corporate level, not at the individual level, it's a lot easier to build retained earnings in a C corporation. And we can fully deduct the wages and benefits that are paid to owners, and it's a pretty familiar business form. So if you go and talk to your banker, they're pretty familiar with this form. They're familiar with the other ones too, but this is a pretty familiar thing. Why an S corporation? Again, the limited liability, no tax at the entity level. That's really a nice one, and no self-employment taxes on the earnings. So that's tax drives a lot of these decisions. Why an LLC? Okay. Thank you. Again, you have limited liability with an LLC. There's no income tax at the entity level. It's a really low maintenance type of organization. It's got a lot less requirements in terms of your annual filings that you have to do, the annual minutes and all of that. It's a pretty low maintenance structure. With this, as opposed to the S Corp or the C Corp, you do have more flexibility in terms of the allocation of profits. Looking over here to make sure I don't get I'm not a lawyer, so just operate these things. It's also a really good estate planning vehicle. So if you're trying to figure out how do I get this onto my kids, there are a lot of advantages in an LLC. Why a partnership? It's easy to set up. There's no income tax at the entity level, and it works pretty easily with federal programs. Federal programs tend not to like corporations, and so there are limitations, payment limitations, and partnerships work a lot better with those than corporations. And then I just wanted to talk, the last slide here is returns. You have returns on equity and returns on effort. And one of the things that we've tried to do in our business is to differentiate. You know, when the business started, it started with a family, you know, a nuclear family. So mom and dad and 4 sons. And they're all involved in the business, and it's pretty easy to, you know, there is no separation between capital and labor. It's all part of the same thing. as that family grows and goes on to each succeeding generation, some people are going to want to be in the business and some people are not. So one of the ways that I think you can help set yourself up for sustainability is to have a return on capital or return on equity and pay people a fair return for the money that they have invested, and then pay people for their effort in the business. And so we try to be conscious of both of those and pay people fairly for what they are putting into the business, both their labor and their cash. And I think that's the end of mine.